Evening, everyone, and welcome to another session of the webinar series which we have been conducting from last few years. And month on month, week on week, we try to come up with something more trending and something which can bring a lot more information to the investors about changing the dynamics of the financial market. And today we are going to talk about the psychology of trading and understanding the emotional discipline, something which is um talked a lot about. And I think it's really important to address that how important the emotions are while we are trading. And you will be surprised to know that a lot of these things, even the best of the best traders in the market, best of the best investors in the market who could have seen profits over profits for years, even they make the same mistakes. Even they are not able to control their emotions a lot of times, and the emotions get the best of them. And that's why it's very important that we should learn and understand to train ourselves and bring that sort of discipline while we trade. And we are going to discuss much more about what are these emotional biases are, and we are going to understand the whole psychology of trading. Now, obviously, this is just one session, and I'll be available for a one-on-one training session as well regarding this. So let's begin with understanding that how psychology in trading works. And when we see, and these are the four most dangerous words in the investing. And these words, as you can see, this time it's different. Most dangerous words in trading, because when we hear and when we understand these words and when we say these words, it shows a sort of overconfidence. It shows a sort of belief that we feel that this time is going to be different. And we have to understand that how uh, modest and humble we need to be when we are in financial markets. So this is what this session is going to be like. Please use your chat options if you have any questions regarding the while we what we discuss. I'll try to answer those questions while we're in the middle of the session, and a few questions, if you want, I can answer while we end the session. Later on, if you want to discuss these things one on one, I'm more than happy to meet in the office premises, or if you want to have a Zoom call or a Microsoft Team call, we'll be able to arrange the same thing for you. Now, psychology in trading is it's really important, because all of us as humans, we go through these emotions. As investors, as traders, psychology plays such an important role in trading. You be whether it's a sports or it's a real time situation, anything, everything what you're doing, it has a certain amount of emotion attached to it. A lot of traders, and you will see a lot of people actually saying that when you're trading, switch off your emotions. You cannot be having emotions when you're trading. That's not completely possible. Naturally, as a human being, as a trader or an investor, emotions are a part of our lives. Separating emotions while we are trading, it's very difficult, because easier said than done, as we call it. So it could be slightly difficult to separate our emotions, but we can manage our emotions well. Guys, just a quick check for your chat options. If you can hear me properly, if you can see my presentation, write a quick yes or a okay. So it will show that everything is audible, and you can try your chat options also. See if it is working. If you can hear me properly, if you can see everything, you can use your chat options to try it yes or okay, and I can proceed further. It will be easy, and you will also be able to try your chat options. This is something which you can use to ask questions if you have any. Perfect. Okay, great. So I think everybody can hear, everybody can see this. Great, perfect. Okay, great. Okay, got a lot of yeses, which means mostly a lot of you have already able to see this. Great. So as I said, that we have a certain amount of emotions, and we cannot separate them, but we can manage them. We have to identify our strengths, our weaknesses. And to give you an example, a lot of times what happens as a trader, and I've seen a lot of traders doing this, sometimes they rely too much on charts, sometimes they rely too much on the news, but and sometimes there are products which a lot of traders they do which do not suit them. So sometimes what happens, like something as volatile as US 30 or Dow Jones. Dow Jones moves at least 300 to $400 in one day, and I'm talking about an index which is priced currently at $35,000. So something which is priced at $35,000 can easily move around $300 to $400 a day. Now, when that happens, uh, you as a trader, if you are trading in Dow Jones and you see that sort of a movement and you have a higher quantity, you will see that a $300 $400 movement can make you anxious. But at the same time, if you trade in S&P 500, which is not priced at 35,000, which is priced at 4,500, is also a US market index, gives you more exposure in the companies. So by trading a lower denomination, you can calm down your senses, because S&P 500 would move 30 to $40. So the whole point is that you have to identify your strengths and weaknesses. You have to understand whether you are a day trader or you are somebody who is a long-term investor. If you are using technical analysis, are you using it right? So your strengths and weaknesses you have to find out. You have to identify that, and that is the best way to manage your emotions. You have to see, and this is something what I tell to everyone, always have a trading journal. If you have not made it yet, please make this. And trading journal is just like another diary, and that could be digital, that could be physical, but the idea is that whatever you trade and whenever you trade at whatever price, whatever quantity, write down the reason behind why you are trading that quantity, why you are trading that instrument for, what is the reason that you bought it or you sold it. What does writing a trading journal does to you? It gives you a rationale, it gives you a reason that why you are doing it. Are you just taking a trade because somebody else told you to, or is it your analysis? Or if somebody told you, has that particular person done analysis, have you checked that analysis? Does that make sense to you? Now, when you start making a trading journal, you will see that a lot of your trades, what you're doing, is just random. There is no entry or exit plan. You just see a price and say, okay, let's, overall the trend is looking better, so I'm going to buy. So if you don't have your entry and exits planned, and if you're a day trader, you are already trying to mess it up. So you have to have a trading journal where you can write your remarks, that what is your profit target, what is your loss expectation. A lot of traders, basically a lot of clients I meet, they don't want to talk about losses, and I think it's completely natural. If I ask you that how much money you are willing to make, you will have a number in your mind, or it will be endless. But if I ask you that how much money you are willing to lose, your absolute answer is absolutely nothing. Nobody's willing to lose, right? But then in real life, to manage your emotions, we have to understand that there are two sides of the coin. When you do a business, when you do a transaction, either you're going to make a profit or you're going to make a loss. Irrespective, you have to decide a number for yourself. You have to decide that when to pull the plug, when to get out of a bad trade. They say that every long-term trade, every long-term trade is a short-term trade gone wrong. So a lot of times this has been witnessed in clients and other traders, that they enter into a trade with heavy quantity for a very small time, and when they see that their losses are happening, they will stick on to that loss. And when asked, they would say that, oh, I was going long term on this trade. So there is no such thing as long term on a day trading. If it's a day trade, it cannot be long term. Day trade, at the end of the day, is going to be a profit or is going to be a loss. And that's how, as a trader, you have to manage your emotions. You have to promise yourself that once I have booked a profit or loss, you may see the market but then wait for a right entry or exit. There are a lot of biases which we are going to discuss today, and how it affects us, how we can protect ourselves from there. Next thing, emotional experience and pre-conscious. So we have pre-conscious thoughts and we have previous emotional experiences. What we see is we have unconscious emotions, and as we know that emotion is very innate, it's very powerful, and it's a very unconscious process. There are a lot of decisions we take and we call them we took an emotional decision, we became sentimental and we took a decision. So it's a very much a human nature to see things to our own personal filter. How many times you take a decision, and to support that decision you need some sort of validation, so you will start seeking people around who support your decision, and kind of drive those people away who do not support your decision. And you're not doing this intentionally. It's just how nature works, it's just how emotion works, it's a human nature. If I take a trade where I buy gold, I would, any news which comes about, uh, how gold can be a good investment for a longer term, I would stick with that rather than getting any news which goes against my trade. Even if it is more authentic or more true or have a higher magnitude, I would not believe, I would not consider that news. Why? Because this is going against me, right? So our past experiences that has nothing to do with trading doesn't determine our present approach of trading. We have to understand this. A lot of times happens, I meet a lot of clients and they say we don't want to do trading because in the past we have done this and we have always lost, and that's why they're never trading. You have to identify that why you lost in the past. Did you take too much leverage? Did you do the trading yourself? Did you not have a consultant, or you were not trading on your own? Did you give your account to someone who was trading on your behalf? Those kind of experiences you have to learn from, because your past experiences, how you have traded back in the past, it has nothing to do with what's your current approach. If you're an informed person today, it does not mean that if in the past you have made profits or losses, it's going to affect your present approach. Today is a different day, yesterday was a different day. What you did yesterday has nothing to do how you're going to approach something today. So please have this in your mind. Just because if you have lost money back in the past, it does not mean that you are always going to lose money, or vice versa. If you have made profits in the past, does not mean that you are going to make profits in the future as well. So you have to be very humble, take trades with proper stop losses, and we are going to discuss about that as well, that how you know in a disciplined way you can approach your trading. Our present beliefs are governed by past experiences that are linked to unconscious emotional memories, is what we are briefly talking about. That what we believe in today, that is governed by our past experiences, and those past experiences are linked to these unconscious emotional memories. So we have to understand that we have to have a refresher, we have to be more informed what's going on today. We can always learn from the past experiences, but then we cannot completely create our beliefs on the basis of past experiences. It always happens like that. Like sometimes, today, if somebody has to invest in real estate, and if they say no, I don't want to invest in real estate because 2008 financial crisis happened because of real estate, that's a wrong belief. I mean, 2008 crisis happened with a real estate meltdown, but that does not make real estate a bad investment. It's just your investments should be more diversified. In 2008, nobody believed that prices of real estate across 50 states of US are going to come down at the same time. But had they seen in 1929, exactly the same thing happened. So you have to learn from your past experiences, but your beliefs are made through information you gain, through new things you learn, through knowledge and experience. So that is the idea which you should have in your mind. Emotion is the main ingredient in developing belief, and that re-experiencing the same or similar emotion helps to keep the belief in the same place. So what happens is, a lot of times this happens, that if you have say for example, any sort of belief you have about your investments, and over a past let's say consecutive year over year you traded in gold and you lost money, that kind of makes a belief and it keeps it there that whenever I trade in gold I'm going to lose. So please control your manage your unconscious emotions in such a way that whatever you do in the past, it does not affect your present or future. You always learn from your experiences, but then your belief should be more than just your past experiences. You have to be more learned, you have to be more informed. There has to be some effort towards uh, doing. If you do the same approach like you did in the past, of course results are not going to be any different. But that's the reason that why you control your emotions and you change things. You identify your strengths, you identify your weaknesses, and then go forward with it. So the wicked four, as we call the traders' enemies: greed. Greed, not just in trading, but I think in any aspect of life, greed is something which it doesn't take you anywhere. Hunger to do more is one thing. Greed is it never ends well. And a trader who's under the influence of greed will always try either not book profit or not book a loss. Even if there is a strategy they are following, they will not, because if market moves up and he sees money and still you are more greedy. I have seen live during US elections that somebody invested and markets went up and the person is making profit, but because they want to see more profit, they do not book that profit, they do not close the position, and eventually market drops and wipes out the entire equity. So greed is one of the biggest enemies a trader can have. Always be away from greed. And I know, as I said, easier said than done, but then there is a way. Always define your profits, always define your losses. In a lot of trading platforms these days there are stop loss and take profit. Stop loss is a threshold beyond which you don't want to keep your trade open, so you book the loss. Take profit is the point where your profit will automatically be booked if you can. So you have those thresholds, use those, and always have at least 1 is to 1 risk reward ratio or a 2 is to 1 reward risk ratio, because you should not be risking more than your reward. You should risk less to make higher reward, or risk equal to make a equal reward, but never risk more with a reward much smaller than the risk, right? Next is the biggest enemy again is fear. If you are always scared to enter, uh, that is a possibility that you will be increasing more and more losses, because fear of losing is one of the biggest problem. Try to minimize your loss, try to avoid the loss, but you can't be scared of losses. That is the biggest problem, because when you're scared of losses, you're even scared to take an opportunity, right? Or when you have taken a trade, you see slide, it is going on the downside, because you have not put up a loss threshold. You're under panic, you're under fear. What happens? Make losses. Why? Because you're not trying to avoid the loss. You're too scared that you do not have any other strategy. So always have, rather than being scared of taking a risk, take a calculated risk. You can always minimize the loss. Tell me how many of you have actually traded or invested in more than two instruments. We have either real estate investments or mutual funds, right? Or we have fixed deposits and real estate, and that is it. How many of you are actually diversified within your mutual funds? How many of you are diversified into different industries? How many of you are diversified into different asset classes like commodities, for example? Within stocks, how many of you are away from, how many of you are already doing only US stocks, or how many of you are doing or are segregated into US and Japan and Europe and like that? Because that is something which is really, really important, and we have to understand the significance of diversification. So, greed, fear, followed by ego. Ego can affect a trader, and ego is one of the biggest enemies of a trader. Because what happens a lot of times, I have seen, when people are egoistic, they have, even when they are making profit, they will be so egoistic, they will not close their profits. They will never close trades even if the strategy dictates, even they have seen the analysis. Even after making a bigger loss, what they will do, because they want to be right all the time, they will take a bigger quantity. So ego has no place. In every aspect of life, ego has no place. Forget about trading. In any relationship, if you have ego, you're landing on the very wrong side of life. And next, revenge trading, such a common factor. A trader loses once, trades in the same direction again. Because of the ego, now they're trying to take revenge from the market. How did I lose this? How did I make such a big loss? I'm going to take a revenge. They do a bigger quantity, take higher leverage, end up losing even more. So, revenge trading should be avoided at all times, and you have to be very, very careful when you are trading. Keep yourself away from these things. Now we move on to something which has been a very popular area of study, and it is currently connected with the field of finance, and that is called behavioral finance. There are studies done on behavioral finance, and you will be glad to know that now a lot of investors are very much aware, and they are very much into behavioral finance. They want to learn more about these behavioral biases, and even a lot of fund managers, they're now very open and very easy to talk, very learned to talk about these kind of biases. And behavioral finance, this is the study of how psychology influences the behavior of investors and the fund managers. And a lot of fund managers these days are very learned about these things, so how they can control the biases. They talk to the clients, they make them aware about these biases, and they even teach them how to control this particular thing. Right, now let's understand more about behavioral finance. So a lot of the entire subject focuses on the fact that investors are not always rational, and how behavioral finance is different from traditional or standard finance as we know. So if I would ask a question, that do fund managers or investors or traders, do they commit errors because they rely on rules of thumb? Now, behavioral finance would answer yes, but a traditional finance would answer no. Why? I'll give you an example. And what is a rule of thumb? When I say rule of thumb means that a lot of investors believe that past performance, it is the best predictor of a future performance. Why do you invest into a mutual fund who has a history of giving 5-year good returns or 10-year good returns? If you see a mutual fund, and if you see in last 5 years the mutual fund has given positive returns, you would immediately invest into it, because that's a rule of thumb. 5-year performance is great, which means we are expecting that the future performance will be good, so we invest into that. That's a rule of thumb. But in a behavioral finance, that's a mistake. This is an error which we are committing, but in standard finance it is all right. Another question, if I ask, like, any sort of form or a substance, does it influence you as a trader? Now when I say form, I mean uh, a decision problem, for example. Like behavioral finance, if you study, you will see there are a lot of objective considerations, like risk and return, for example. If we see, normally people talk about high risk high reward, right? If you take a higher risk, you will make higher return. But then we have to understand where we are taking this risk. If you're investing into a cryptocurrency, you're taking a high risk. You might end up making a higher reward, but at the same time, you have to see how high this risk is into an asset class. So it's not necessary that every time there is a high risk and high reward. You have to compare your asset class as compared to a cryptocurrency, for example. As compared to a cryptocurrency, there are other asset classes where you can take a equal risk and get a much higher reward as compared to a cryptocurrency. So asset class is important. Also, another question, if I would ask, do errors and decision frames affect the prices established in the market. So again, there are a lot of biases in the market which are available. So let's say, for example, if Apple launches a new product, it doesn't matter how expensive the product is. I, as an investor, and many investors like me, would go and buy Apple stock. Now, that's not rational, right? So, this is what shows the inefficiency in the market, which is picked really nicely by behavioral finance. But standard finance wouldn't pick this. So, behavioral finance now has been a very important field of study, and a lot of investors and fund managers are now getting used to it. They are trying to understand, and leaving their egos aside, everybody has accepted that there are a lot of behavioral biases which we have to take care of. Now, let's look at the most important part of the session today. So, top 10 behavioral biases which we are here to discuss. And a lot of these biases, this is not something which we are not very much aware of. I think this happens in our everyday lives. And these are some errors which you will always find. Let's, like, if I'm seeing at this, let's say, let's pick, for example, confirmation. And confirmation is, or confirmation bias, when we talk about confirmation bias, what it actually is. So you, as an investor, will develop a tendency, and if you see, like, for example, I, as an investor, I will look for that information that confirms my beliefs and ignore whatever contradicts my beliefs. And this is something which is really important. Most experienced private wealth advisors, like most experienced private wealth advisors, have dealt with a client who conducts some research, insists on adding a particular investment to the portfolio. A lot of times, clients, they insist on continuing to hold on to the investment even when the advisors, they're recommending otherwise, because clients' research is only seeking information that is confirming their belief, right? So confirmation bias, it is not just limited to individual investors. There are a lot of fund managers who are also, they succumb to it, right? There are a lot of sometimes portfolio managers. That's why we have to understand, when we talk to our fund managers, we have to be very careful, and we have to assess them as well, because at some point of time we have to understand that confirmation bias is basically satisfying our ego, where we feel that, okay, this is something which is good, and I have taken that trade, I'm on the buying side, so every news I'm going to see is going to be about that. Now, what are the consequences? I will only consider a positive information about an existing investment, right? I will ignore anything negative about it. uh, I will not diversify into anything else, because I have taken a few trades and I have a vision for that particular trade. I'm ignoring all the negative news, right? Only taking positive news, which shows that my investment is good. I will continue, because how it works out, if I have bought Apple stock and I am so into it that I ignore any negative news about Apple, what I will do is, every single penny I have, I will keep investing into Apple, and I will not diversify at all, because I have this belief, and every news I get confirms my belief that Apple is a good investment, because I'm ignoring the negative news at all. So what it leads to is holding a very disproportionate amount of my investment into one asset class, just because I have that belief and I refuse to entertain any negative news about it. So this is something which we have to understand, because the effect of this bias, it can always, like, it can be corrected, it can be reduced. How would you reduce it? You get more and more information, always, like, and always corroborate an investment decision. Like, if investment decisions are based on criteria confirming something, like, for example, always try to do more and more fundamental research. Like, if you see, get a news that Apple is getting an iPhone, making a new iPhone, instead of just buying on those bases and looking at the positive side, try to look the balance sheet of Apple, try to look at the fundamentals for Apple, how strong that is, right? So that is something which is really important, and we should always be very open to this idea, because confirmation bias is very very common. So do not think that this is something which cannot happen to you. Look in the list, there is something called hindsight, and hindsight is also something very common. So what sometimes we as an investors we receive, like we feel like, for example, when the financial crisis in 2008 happened, every person lost the money. Like a lot of people lost money, but a lot of people also who lost money said, oh, we saw it coming, this had to happen, right? So what we do is we believe that whatever past events, like whenever something bad happens, we in our mind we always say that, oh, this was predicted, this had to happen. So basically what is happening is, when the outcome that occurs, and when it's obviously the result from that obvious fact, that outcomes that did occur, they are more readily evident than outcomes did not. Like for example, a lot of people, they remember their own predictions of the future as more accurate than they actually were, because they are very biased by the knowledge of what have actually occurred. I'll give you one example. So let's say, for example, a particular analyst in an investment advisory firm is giving a presentation to the clients, right? And it explains the firm's investment results during macroeconomic downturns. Now, in that presentation, if the person points out that occurrence of the last recession was very obvious, right? Now, that means recession, like any other event, appear obvious in hindsight, but nobody is very accurate about it. Like a lot of you these days always talk about how recession is something which is so obvious. I mean, the moment economy falls into recession, every investor is like, yeah, I predicted recession had to come. But were you ready for it? No. Everybody's in a loss. So hindsight is something where when the worst thing happens, you come out as an investor that, yeah, it had to happen. What are the consequences? The consequences, again, it's something which is really really important, because we overestimate the degree to which we have correctly predicted an investment outcome. We may not know, like, okay, I lost my money because recession came, or I lost my money because of poor handling, right? I may just put everything to recession because I feel that I predicted it right. Now, the most important way to remove this bias or control this is that you have to understand, and you have to ask yourself this question, or you have to ask your fund manager this question: am I rewriting history or being honest with myself about the mistakes I made? Every time when you take a trade, you have to ask yourself that, is this something which I have done back in the past? That's why you make a trading journal. That's why it's very important to make a trading journal, because if you are not making a trading journal, then that means you are not even you don't even remember what you have done in the past. So please make a trading journal. Ask yourself this question: that have you done this back in the past? Are you doing exactly the same thing what you have done in the past? If you are, then do not expect different results. That is all something what you need to remember. And a lot of these biases are very emotional. Look at overconfidence, for example, the very first one. Now, overconfidence is all about when us as investors we demonstrate some sort of faith in our own abilities, and it's very very intense sometimes, because I have seen a lot of times traders, when they make profit, they take too much credit for their success, right? And then when they fail, they find someone else to put the responsibility on. So if something happened really good, which is a very different, like overconfidence bias and self-attribution bias, if I combine them together, because self-attribution bias, self-serving, what they call it, if it combined with overconfidence, if I make a profit, I appreciate myself too much, but the moment I made a loss, I put it on someone else or something on the economy, that this was supposed to happen. I mean, this is what else we can do. So overconfidence also has two sort of forms. There is a prediction overconfidence, and then there is a certainty overconfidence. So both of these overconfidence, they have basically, they demonstrate a very faulty reasoning, right? Like sometimes if you talk to people, they say, I have a gut feeling about this, or I hope that this reverses. Prediction overconfidence, this occurs when confidence intervals that you assign to the investment predictions are too narrow. So I'll give you an example. Like for example, if I have to estimate a future value of a stock, so as an overconfident person, uh, I will be putting a very narrower range, a very lower standard deviation, right? Like for example, it's not going to move too much, or I don't think it's going to go down too much. So if you, the moment, for example, you buy gold, it's a, yeah, from here it's not going to be coming down too much, right? This is prediction over confidence. You predict a very narrow downfall. What is certainty over confidence is when probabilities are too high, and then it's an emotional response, right? If the market has gone up, now you're expecting, no, it will go even much higher. That is certainty over confidence. So you have to be very careful, because the consequences is really bad. You're really underestimating the risk, and you are overestimating the returns. Both of them are really wrong. Again, very poor diversified portfolios. Anybody with an overconfident bias, the if you're not, if you're too overconfident, you are not going to diversify much. So that is not, again, the right thing. So when you are calculating your portfolio winners and losers, you always have to see how much money you have lost. It's very critical. Uh, Please do not confuse yourself. Always mentally separate your good money making decisions from your bad ones. It should not be like, oh, I take 10 trades, three of them went right, and I'm focusing on three of them, and I become overconfident. No, you have to see all your trades together, and you have to realize that this is something which I have to improve. And if you see something called narrative fallacy, also is a very important bias, because when we see, and I'll just give you one example. Like, let's say, for example, and narrative fallacy bias, it's very very common among a lot of investors, because that basically causes us to gravitate, like to be influenced by a very good investment story, even if they are overvalued, right? Because this is something, like for example, if we hear that a stock of a company has fallen down, right, and then hear that chairman of a company is selling the stocks, now we try to link the facts together and form a story, and most likely the conclusion would be that company is failing and the chairman is jumping the ship. But this is just our story, and this is what a lot of times, because these days media is very good at making stories. So please interpret the right information from the narrative. If Tesla is overvalued, but you just love how media shows Elon Musk as the Iron Man, or how an article shows Elon Musk as Iron Man and AI and space exploration, that has nothing to do with you buying Tesla. You should be buying Tesla because of the fundamentals. If they have strong fundamentals, if their balance sheets are stronger, if they have a history of generating revenue and profit consecutively, if they are delivering electric vehicles on time, if they're doing better than their competition, that should be your motive, not because Tesla is a good story. So narrative fallacy is something which you should be very, very careful about. Next, few of them, like herd mentality, for example. Herd mentality, it's one of the classic thing. Everybody talks buy Apple, buy Tesla, or whatever is in the news. You just go with it without even checking whether that is the right stock for you to invest in. All right. So that is something which should be avoided. Don't have the herd mentality. Don't just join the group. Always have your own fundamental, own analysis. Next, if you see loss aversion, for example, loss aversion, it is basically a tendency where a lot of people are basically trying to avoid loss to achieve gains. And so the idea is, again, as I said, you always have to understand that loss is a part of your investment. Loss aversion, it leads an investor to hold their losers to avoid recognizing losses. So what happens is, you have a trade, you buy something, and now what is happening? If you have a trade, and you bought something and prices are going down, because you're so scared of losses, you want to avoid losses at all costs, you don't want to see a red in your portfolio, you will continue to hold on to it. And that is a very very wrong mentality. That is something which is really bad, and it's definitely a psychology issue in among the investors and traders, that we hold on to our losses for too long as compared to our profits, and that's really wrong. So always be very careful, avoid herd mentality, avoid loss aversion. And then there are other biases also. Like for example, if you see, anchoring bias is something which is really talked about. And anchoring bias, it's all about, you get one initial piece of information, and all your decisions and judgments are based on that initial piece of information. How anchor digs deeper, and then it holds the ground. So anchoring, the word itself comes from the point where you get an initial piece of information, and that information becomes the anchor for all future decisions, right? So for example, if I have seen Apple stock, or let's take example of something else. Let's say if I have seen gold prices at $2,000 per ounce, and now if it has gone up to 2050, again prices came down to 2000, and if for 3 or 4 times I have seen that from 2000 it is bouncing back, I would be not able to process if gold prices drops below 2000. I would continue to buy at 2000. If it goes down below that, then it's my loss. So anchoring is something which is really important. It's a very important bias, because a lot of times we have an initial piece of information, and then our decisions are based on the basis of that information becomes the anchor ground, and we take all our decisions thinking about that particular information. So we have to be very careful. And again, as I said, the consequences can be very bad if you go through the anchoring bias, because what happens is, if you're stuck too close to the anchor, that information, you will avoid any new information which comes to you. So your mindset is very limited, and it is not considering any changes, because you are just stuck to that piece of information like an anchor, right? So the idea is, always ask yourself, am I holding on to this stock based on rational analysis, or I'm trying to just attain a price that I'm anchored to, right? Sometimes a lot of investors, they have that, I'm not going to close this stock, let it come to this price. Why that price? Because it's in your mind, right? Let's not book the loss until this level gets broken. Why? Because it's in your mind, you have seen that level before, so you still stick onto it. So always try to be away from these biases. These are very important and very common amongst us as investors, and the best of us can succumb to these biases. So this is exactly how a lot of times traders work. When the market are at its peak, so somebody would buy and like, okay, markets are doing really great, I'm ready to buy. And when there is a slight contraction comes in, now I'm losing, I regret this, but you are still holding on to it, right? And finally, when you're into a recession, when economy is into a recession, that time you feel, oh, now it's time to sell, I cannot sleep, right? Again, when slight expansion starts happening, maybe the share market isn't so bad after all. And then again, when it's peak, look at those returns, I'm ready to buy again. What happens is, a lot of times you buy at peak, and then you hold on to the losses and sell it at the bottom. And that's where the market starts recovering from. So you have to understand, you start buying, try to buy at near the bottom, and try to sell it at the peak. If you have bought at the peak, and if you see prices coming down, get out and take care of your losses. Do not hold on to it to the point where you start selling exactly at the point from where market is reversing from. So this is something which happens really, really common. The trading position, please never add to a losing position. Always determine a stop and a profit objective before you enter a trade. Always place stop loss based on market information, not your account balance. If a proper stop is too expensive, don't do the trade. So a lot of times we see that we take a trade, let's say in gold, and we see that we have account value of say $10,000, but we have over leveraged it, and I have 100 ounces now. Now I know that if it goes down by $30, I will lose $3,000. But I would obviously, because I've taken a bigger quantity. So instead of taking a bigger quantity, please do a smaller quantity and then you can keep a stop loss $20, $30 down. Maybe market information tells you that gold is going to go down $30 and then bounce back. But your 100 ounce position does not allow you to keep a stop loss $30. So you put stop loss just $10 down. So it hits your stop loss, comes back, and then you are again angry about it. So put stop losses as per the market information, as per the technical analysis. Don't put a stop loss just because your account cannot handle it. If your account cannot handle it, then your quantity should be lower, or just don't do the higher trade. Manage your quantities well. Remember the power of position. Never make a market judgment when you have a position. Right? Your decision to exit a trade means your perceived changing circumstances. Don't suddenly think you can pick a price or exit at the market. So plan your entry and exits basically. And what is the disciplined routine? Always determine the market trend. Check the support and resistance levels. Your trading approach should be defined. Do I have to do a longer term trade or a shorter term trade? Right? Write your trading plans every day. Put your trading journal. Accept the risk. Stick to your risk and reward ratio. Always. Sometimes I see people are ready to bear losses $1,000, but the moment they see the same trade in $100 profit, they will book it. Right? That is not right. And last, come to us for a cup of coffee. So basically, we have a lot of financial consultants over here. If you can't figure out what to do, please come to us, sit with us. We'll explain these things to you just over a cup of coffee. And I think that should make a lot of difference. Right? So guys, if you liked this session, please review us on Google, on Century Financial. We are on Google reviews. That motivates us to improve on the sessions, bring back more sessions on different topics. Next week, we'll be back on a different topic with a different session. And I hope that you liked these sessions. And most importantly, please continue to trade safe. If you have any doubts and questions, I think there are a few questions over here. Is this something what you do weekly? Yeah, a lot of our sessions are mostly done week on week basis. So like last week we did something different. This week this is something different. Next week we'll try to do something different. Can we have one-on-one sessions over Zoom? Yes, Zoom or Office, you can always come, and we'll be more than happy to sit with you, even devise a couple of portfolios if you tell us your risk and rewards. So Century, as a company, we are investment consultants, and we have a team of research and consultants who are looking at the market, preparing strategies, sitting with the clients, trying to understand their risk and reward. And on those basis, we also draft portfolios for the clients. We teach a lot of investors and traders how to use the trading platforms, how to put stop losses, and there are training programs which go on, and all of these programs are free of cost. So please take time out, come to our office, sit with us, and we'll make you understand how these things work. This is no rocket science. I think all of us have emotions, and some of us have the ability to manage it well. Some of us will learn to do it better. Can you please arrange a session for beginners? Absolutely. See, this session is it's a very common session. I mean, whether you have traded or not, this is something which happens a lot of times. But yeah, if you're talking about market trend, support, resistance, we can definitely have a session for beginners. And if you need a one-on-one session also, sometimes I do sessions and people join in. This is very basic stuff. We want to have more advanced. So that is the only thing. But if you want to have something very customized for you, we can have one-on-one session on Zoom. You can come to the office. Either way, whatever is okay. and I'll definitely arrange a very beginner session. So do not worry about it. We can definitely do this. Right. So, unless you have any other questions, thank you so much for your time. And we'll meet you next week. Let's hope that you continue to trade uh, and be away from these biases, manage your emotions well, talk to us, and we'll definitely be able to assist you. So, my name is Yogesh. Thank you so much for your time, and you have a good night, and we'll see you next week.